Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Where we're going to finish our discussion of the Week 5 lecture notes. Specifically, we're going to look at the different definitions of alpha and beta. And then we're going to go into the mid-semester exam. I'm going to talk about the guidance note and then a couple of past exam questions as well, just to give you a feel for the setup. Apologies again for my lack of sleep and therefore slightly jumbled words yesterday. I should be better today. I did actually get some sleep. But if you have any questions about anything we did yesterday, let me know as well. So remember, we finished yesterday with me saying that up until now, you guys have always looked at beta as a definition of a risk that is non-diversifiable. And because you can't diversify that risk away, market participants need a premium to persuade them to invest in it. Which makes sense, right? I mean, we're risk averse, so all else equal, if we're going to take on a risky asset and we can't get rid of that risk ourselves, we won't invest in that asset without additional return to compensate. That's a completely legitimate definition of beta. It does restrict the potential beta factors, though, because remember, they have to be non-diversifiable. Now, what's our one key source of non-diversifiable risk, the biggest source? It is the economy, but if we're talking about an equity model, the market risk, right? It's the market risk premium. And which is absolutely closely tied to the economy. In fact, the stock market is a leading economic indicator. In other words, when the economy is about to go into recession, the stock market tends to do it beforehand. Can anyone think why the stock market might move before the economy? How would you calculate price? It's investor outlook, right? Because the price is the present value of the future cash flows. So the outlook of investors will affect what they see the future cash flows to be, right? So if investors are starting to see a recession coming, before the worst of it occurs, their outlook has changed, which means they believe future cash flows will be lower, which means the stock price starts to fall. So that definition of beta is what we call the theoretical definition. In other words, beta is based around a non-diversifiable source of risk. The key non-diversifiable risk is the market risk premium. Arguably, though, the French factors, so remember small stocks, the return on small stocks less big stocks, and the return on stocks of high book-to-market values less low book-to-market values, they fit the theoretical definition as well. Farmer and French have worked very hard to argue that they do fit the theoretical definition. Even though it's not the broad market, it seems like these risks are hard to diversify away. In industry, though, the definition of beta is more loose. Because in industry, think about your average mum and dad investor investing in a mutual fund or a super fund. The idea is they're going to ask, do I pay a manager to produce what they argue is alpha, right, an active return? If you're an ordinary investor, you're not really going to sit there focusing on non-diversifiable risk. What you're going to ask yourself is, can that manager do something that I can't? Right? And this comes back to everything. Think of it's tax time, right? So those of you that are lodging a tax return this year, if your tax return is really, really vanilla, you know, you've got one source of employment, you've got your tax statement, so you know your taxable income on that. Let's say you've got no interest, no stocks, so no dividends. Essentially, all you really need to factor in is a Medicare, maybe private health insurance, and your income. It's really easy to get on the government tax site and lodge that tax return yourself. So you would be more hesitant to pay an expert to do the tax return for you. And if you do go to an expert, you're not going to pay very much. If you're sitting there with a tax return and you have trusts, you have worked part of the year overseas, you have dividend income, you have capital gains, you have interest, you have rental properties, some of them are negatively geared, others aren't. As you have dependents, as these start to get more complex, now you're willing to start to go to an expert and pay them for the tax advice, right? Because it's something that you're not comfortable feeling like you have fully achieved yourself. Or if you feel like you could probably muddle through it, you might wonder whether there's a loophole you might miss that would mean that you get a better tax return that an expert would be able to do for you. The industry definition of beta, what they see as a beta factor, is any source of return that can be cheaply and easily replicated by anyone, right? And the idea is beta is achievable, so shouldn't command a high fee or a high reward. Alpha is rare, it's based on skill, so then you pay for it. So the industry definition, think about it as, am I willing to pay for an active manager, right? You're not going to pay a lot of money for a manager to go and track an index, because you could invest in an index by buying an ETF, right? BlackRock iShares, you could get global equities, you could get domestic equities, there are ETFs on fixed income, there are ETFs on commodities. Most asset classes you could invest in through ETFs. If the exposure is easy to do yourself, that is defined as a beta factor under the industry definition. And there is overlap. Typically, what is available in the theoretical definition as beta will also fit the industry definition. It's easy to buy a market ETF. That's your market risk premium. It's easy to go and invest in small caps. It's easy to go and invest in value stocks with high book-to-market ratios. But there are things that fit the industry definition that don't fit the theoretical definition. So, for example, momentum is part of the Carhart model. That fits the industry definition of a beta factor because it's easy to look at past returns and buy the recent winners and not short, but at least sell the recent losers. But momentum, while it's priced in the market, isn't a risk factor. It's not non-diversifiable risk. Because there's nothing inherently more risky about stocks that have been recently going up in value, right? So when you decide, is beta going to suit the theoretical or the industry definition, this is what you should ask yourself. Can I diversify the risk away? If you can, it's not a theoretical beta. But if you can diversify it away, but you can also access it cheaply on your own, then it fits the industry definition of beta. So we're going to go through a lot of different, we'll actually split it up into another 4 frameworks. But the point is, when you're looking at whether an active manager is going to add value, you need to look at their alpha. And alpha will be different depending on how you decide to define beta. So just to show you that using a model as simple as the CAPM, which fits both definitions, your alpha is equal to the excess return of the stock less the risk-free rate. And by the way, I'm just modifying. I'm just modifying this to incorporate alpha, because alpha is a return in addition to the return expected by the CAPM. So you essentially bring everything to one side. Let's say you have a stock, a manager invests in a stock with a beta equal to 2. So it's a stock that has a lot of market risk. Let's say the expected return on the market is 10%. Let's say the risk-free rate is 5%. Then what you'd expect that return to get, based on its systematic risk, is your 5% risk-free rate plus your 2 beta times your 10% return on the market less your 5% risk-free rate. Or 15%. If the manager ends up with a strategy that gives a return of the fund of 15%, that's all beta, right? So for you to be impressed by the return that a manager produces, and by the way, I've done the calculation saying it's a stock. You run these you run these models on fund returns as well. So if the fund has a beta of 2, the risk-free rate is 5%, the market risk premium is 5%, then the fund, if it has a 15% return, that's not impressive. Under the theoretical definition, you're going to say, why would I spend money for this manager to give me a 15% return? Because the reason, or at least why would I spend a lot of money, why would I pay an active fee? Because the only reason they've got up to 15% is that they've loaded up on systematic risk. Yes, it's higher than the 10% the market produces, but it's also a lot riskier. I'm not impressed by that. I don't want to reward it like I would if a manager produces returns due to skill. Under the industry definition, the outcome is the same. Why would I spend money for a manager to get me a 15% return? But here, the reason is that you could essentially get a leveraged exposure on an ETF. You could borrow money, put your own money and the borrowed money into an ETF, and end up with a 15% return yourself. But if the return on the fund was 18%, then you've got 3% alpha. You're willing to spend money if a manager can get you more than 15%, because that is additional risk-adjusted return under the theoretical definition, or additional return beyond which you could achieve yourself with a ComSec account, right? That's the industry definition. Does that make sense? So there are some models like this one where the outcome is the same, but the interpretation differs. And then there are beta factors that you can add into the industry definition that you wouldn't add into the theoretical definition as well. So this is why the concept of alpha and beta in the industry is actually a lot harder than what you might think after doing a course like investments. If you're going to talk a little bit more about how to view beta versus alpha, think about, these exactly suit the industry definition, but they apply to the theoretical definition as well. Beta is widely available because it's easy to get, right? I can easily buy an ETF on the S&P ASX 200. Alpha is not easy to do. There are not a lot of skilled managers out there, right? In the US, the average manager, active manager, underperforms the market. In Australia, the evidence is mixed because it depends on the space. In small capitalisation stocks, managers do better. But in large cap, average active managers in Australia are not outperforming. So it's hard to get alpha, and so it should be rewarded because it's valuable. Alpha is often considered a zero-sum game. Now, this was actually first thought up by Bill Sharp of the Sharp Lintner CAPM in a paper that he called The Arithmetic of Active Management. Think about a general sports game. For every winner, there's a loser. Think about purchasing a stock. For every buyer, there's a seller. So when you produce positive alpha, if you outperform the market, somewhere out there is someone that is underperforming, right? Because the average of all investors, all investors' trades, the return has to equal the market return because all investors combined make up the market. So if all investors combined make up the market, for the ones that win, there has to be ones that lose as well. That's the argument that Bill Sharp put forward. There are a few caveats to that that we'll actually look at later in the course, but it is a very persuasive argument. Because alpha is so hard to do, because we can't all achieve it, it's valuable, so should be more expensive. Beta is widely available, so it should be cheap, right? Just like the tax return. If it's hard to do, if it's valuable, you'll pay more. If it's easy to do, if you're willing to pay, you won't pay very much. I do have friends that have really vanilla tax returns and go to a tax accountant just in case they might miss something, but they spend a lot less money than some other people I know that have very complicated tax situations and pay a lot of money to get their tax returns done. The last thing is, because beta is associated with either a non-diversifiable risk premia, which this first one, is that industry or theoretical definition? Theoretical. Or the passive market exposure that's sustainable over time, that's the industry definition. So they're the two things that beta could be, whereas alpha is typically associated with investment skill due to security selection or market timing. So you can see they're very different things, and therefore they should be worth very different amounts. So that's two sort of broad ways to see definitions of beta. Just to make things a little more complicated, your examinable reading, which is a fantastic reading, by the way, gives you 4 different ways to view beta. And I really recommend that you go through this carefully and understand the different ways to look at it. Because it's really important when you start with your investor that you know what definition they're going to be referring to, because you need to know what they are willing to reward. Now, luckily, rather than having 6 different breakdowns to learn, the good news is that the financial economics framework is essentially the theoretical definition, and the performance attribution framework is essentially the industry definition. But these are all about how to define beta, because remember, it's only once you've defined beta that you can strip out your alpha. Financial economics, which is like the theoretical definition, beta is your priced risk factors, right? Your common non-diversifiable risk factors that therefore command a premium. So your market risk premium from the CAPM, the small minus big or high minus low factors of the Farmer and French model. Alpha is anything in addition to the return attributable to beta. The performance attribution framework is like the industry definition. And again, remember, beta is whatever you can easily do on your own. So it's widely available and easily accessed. It might happen to come from a priced risk factor that you can replicate, like purchasing small stocks or purchasing a market ETF. Or it could not be a priced risk factor. It could just be a persistent market inefficiency, like momentum. It doesn't matter. It could be either of those. The key is that you can easily replicate it yourself. And alpha is skill and should be identified and rewarded. And that line about alpha is actually applicable under the financial economics definition as well. But the theoretical definition often argues that there is no alpha. So it's sort of the odds are against the manager. It's under the theoretical definition. But alpha in either case is valuable and therefore should be able to command higher fees from a manager. The risk modelling framework is broader. It's a little bit like the fundamental risk approach in the way it looks at risk. Here, the beta doesn't need to be what we call priced. It doesn't need to command a higher return. It just needs to be a risk exposure that affects your portfolio. So that might be that you have concentration in a particular industry. It might be illiquidity, right? Whatever, you could end up with 12 different identified risk factors under the risk modelling framework. It's whatever sources of exposure are affecting the returns, affecting the volatility of your returns through time. Alpha is idiosyncratic. It's not a common source of variation across the different stocks. Now, and your beta exposures should be identified and managed, right? So again, like the fundamental risk approach, what are my key exposures? Let's model them to keep track of them so that we don't end up with too concentrated exposures in any particular area. And exposure replication and hedging, which is probably the least, it would be the most rare way to look at it, but is very popular for people that believe in things like portable alpha, which we'll come to in a moment. Here, beta is anything that can be replicated or hedged using things like derivatives like index futures, using ETFs, using swaps, etc. So it's something that you can essentially replicate in some way. So you might replicate market beta through an index ETF. So the market risk premium could sit under any of these different factors. But, for example, you might have an interest rate swap, and that would be considered, therefore, a beta factor. So I really recommend going through this reading carefully. It obviously matters because it's tied into the slides, but it's amazing how different your alpha will be depending on the context under which you define beta. So given that there are so many ways to define beta and therefore alpha, it's not a surprise that there is a lot of issues surrounding its use. The first is that beta isn't unique, right? Let's just take the most obvious beta factor of the market risk premium. Under the theoretical definition, so the financial economics framework, it should be a broad-based market index. So in the US, that would be all NYSE, Amex or NASDAQ stocks. In Australia, that might be the All Ords, or you might go broader if you can say any stock currently listed on the Australian market. But under the industry definition, remember, it's anything that you could access using an ETF. So do you use the S&P 400? Do you use the Russell 3000? Do you use the MSCI World Index, the FTSE, the All Ords? Right? Beta is going to depend on how you choose to define it. The next issue is that alpha tends to come from one of two ways. It can come from security selection or market timing. Now, security selection easily fits the definition of alpha, right? Because you're purchasing underpriced stocks, you're selling overpriced stocks, and you're waiting for the market to correct. Easy to say, hard to do, and definitely alpha. Market timing, which is just as hard to do, but here what you're doing is if you predict that the market's going to go up next period, what will you do to the beta of your portfolio before it does? Increase it. You'll go into higher beta stocks. So when the market does go up, your portfolio goes up by more. Now let's stop there for a second. You've gone into high beta stocks, the market's gone up, so it makes sense that your portfolio has gone up by more because you were in high beta stocks. So in any one period, that looks like beta, right? It doesn't look like alpha because, of course, you got a higher return, your beta was higher. Now let's change the condition. Let's say you predict that the market's going to go down. Before it does, what would you do to your beta? You'd lower it. So then when the market goes down, your portfolio goes down by less, or ideally even stays relatively constant if you've really hit non-cyclicals. Now, again, in that one period, all right, the market went down, you went down by less, but that's only because your beta was lower. So it was less non-diversifiable risk. It makes sense that it didn't go down. It wasn't as vulnerable to the market movement. So in any one period, your return is what you'd expect based on the beta. It's only when you add the periods together that you start to see the alpha coming through. Because when the market goes up, you do better than the market. When the market goes down, you're still doing better than the market. But it really, therefore, is sensitive to the period over which you're going to actually calculate the alpha overall. So that makes market timing a little bit harder to detect than stock selection. This third one is really interesting, and it's the AQR guys wrote a great paper called Is Alpha Just Beta Waiting to be Discovered? And what they argued is over time, we're detecting more and more risk sources. Right, so think back to the 40s and 50s. There was no CAPM. So if everyone on this side of the room, if you guys got a 12% return on your fund, and you guys only got a 10% return on the fund, well, you guys were better. You were skilled. Then in the 60s, the CAPM came in, and it turns out that the reason you guys got a 12% return is that you were taking on higher beta stocks, right, stocks with higher market risk. So now I'm not impressed by you anymore because, of course, you got a 12% return. Your portfolio was riskier. You guys got a lower return, but you had less non-diversifiable risk. So that was the biggest source of outperformance stripped away. But at least you guys could still buy small caps and value stocks and try to outperform the people on my right that way. Then comes 1993, and Farmer French create the three-factor model, and now suddenly I'm not impressed by you buying small stocks and outperforming, and I'm not impressed by you buying value stocks and outperforming. But at least you can still chase momentum. Until 1997, when Carhart came up with the four-factor model, and momentum was taken away from you as well. So you can see with each new source of identified beta, with each new factor model, and there's another one coming out every month, it feels like, the sources of available alpha, the idea is that they're going to slowly shrink away to nothing, and it might be that what we're calling alpha now is a beta source that we haven't yet discovered. And maybe there is no such thing as outperformance, it all comes down to risk. And the last issue I mentioned last week as well, and that is that if you have an alternative asset class where there isn't a very good index, it can be hard to strip away the alpha versus the beta, right? Because if you're going to put it into some kind of model and attribute something to beta, you need a return series that is going to be your beta source, right? So, for example, you need in the industry definition, easily accessible ETF. In the theoretical definition, you at least need the data to show a broad-based index. In something like infrastructure, it's very difficult to do that. If you can't figure out what the return is due to beta because you don't have a good index or a good ETF, it's hard to decide what's due to alpha as well. So if an infrastructure manager goes well, Part of it might be because of the specific infrastructure projects they've invested in. Part of it might be that the market's doing well overall. Without a good beta source, it's hard to strip them apart. So the last thing I wanted to do is talk about some of the applications of alpha and beta. This first one was really popular for a while until it turned out it's actually a little bit, well, it's difficult and it's expensive to do. So it's actually lost popularity. There are far less people claiming to do portable alpha, but it's a really trendy concept. Let's say you have a manager, and rather than just read off the slide, I'll give you an example because it's easier to see with the numbers. Let's say that you have a manager that invests in a portfolio with a beta equal to 1, right, just for simplicity, and its alpha is 3% all the time. So this is a good manager, alpha 3%. Now let's say that the return on the market was 7% in period 1 and negative 7% in period 2. The fund, because the beta is 1, and let's just assume, by the way, for simplicity, that the risk-free rate is 0, right? It's just to illustrate the concept. The fund would therefore have a return of what amount if the market's 7%? 10%. If it's negative 7%? Negative 4%. So this is a good fund. It's giving you a 3% alpha in both periods. But let's say you're an absolute return investor and you didn't want to deal with a negative return. What portable alpha says is use derivatives to get rid of your beta risk and enable you to keep only the alpha in a particular asset class. And then you might want to combine that with beta in a different asset class by taking on a derivative in fixed income, for example. But let's just look at getting rid of the alpha. Let's say you go short in a market futures, so that when the market goes up by 7%, what will be the return on your short position? Negative. It's a futures on this particular market, so negative 7%. And when it goes down by 7%, your futures position goes up by 7%. So the net position, when you combine these two trades, yeah, and 3. So now, because you've taken a short futures to get rid of the beta risk, you're left with your alpha, positive return, positive alpha, irrespective of the market condition. So it's a really gorgeous concept, but there's a few problems with it. The first is that you need to be able to trade in derivatives, which a lot of funds aren't allowed to do. It's not in their mandate. If you can't trade in derivatives, it's not an option for you. The second is, even if you can trade in derivatives, you can only hedge away a beta risk, providing there is a suitable derivative contract on it. So for the market, in most cases, that's fine. But once you start to get more unusual beta exposures, it becomes harder to find a derivative contract that will, with that exposure underlying it. The third issue is, let's say that you're going to do it with something like options, not futures. Then you've got premiums, and that can be quite expensive. And when it comes to expense, even if you're going to use futures, what happens every day with a futures contract? Marking to market and potentially margin calls if you make loss. So in cases where you're gaining in the fund and losing in the futures, you're going to have marking to market and potentially margin calls that you need to satisfy. If you don't have the cash, you're going to need to sell off some of your assets, and you may not be ready to do that. You might have a longer term strategy and not want to sell straight away. So it's a beautiful idea, but it's actually a lot harder to do in reality, which is why its popularity is waning. Now, the next thing, which is actually a really hot area right now, is what we call smart beta. And unlike portable alpha, which is losing popularity, smart beta is really picking up speed, right? BlackRock estimates global ETF assets that are focused on smart beta to reach $1 trillion in 2020 and $2.4 trillion by 2025. Think about a normal beta strategy and think about the industry definition. Essentially, beta is just taking on a broad market exposure that's passive, right? So, for example, you will have a passive exposure in the S&P ASX 200 by buying all of the stocks in the market in the proportions that they exist in the market, right? So traditional beta has market capitalization weightings. Is everyone happy with that? Now, smart beta, you're still creating a diversified beta exposure by purchasing most or all, depending on the strategy, of the stocks available in that index. The difference with smart beta is that you're not using market capitalization weights. You're using some other form of weighting strategy. That might be the weights that create the minimum variance portfolio. It might be weights that mimic the size, value or momentum factors, so put more weight in small caps or value stocks or stocks with high past momentum. It might be weights based on fundamental indexation, so you might link things to company sales or profits or dividends, right? You might put a higher weight in companies whose dividends have been higher over the past year. And actually another one is as simple as 1/n. You might just equally weight the stocks. All of these weightings have been shown to outperform a market capitalization weighting. And that's why it's called smart beta. You're still diversified and you're still passive, although you do need to rebalance in the smart beta strategy. So it's still beta in a way, but it's better than beta. It's smarter than beta because you're getting an additional return per unit of risk than your standard beta strategy. And this, by the way, is it's not an examinable reading, even though it's on the slide. I will not test you on this reading, but if you're interested in smart beta, have a look at this reading because it lists a lot of them in detail. And they're strategies that are executable by an ordinary investor. And the last one is exotic beta, and I love that name. Exotic beta, think about the CAPM. If you have a stock with a high beta, then it has a high correlation with the market risk premium, right? Now, stocks with a high correlation with the market will command a higher return because they have non-diversifiable risk, right? So you need a higher return to convince people to invest in them. What exotic beta is it's an investment that has a low correlation with global equity markets. Now, with a low correlation with global equity markets, if you hold a well-diversified portfolio, you should be able to diversify that risk away, right? What exotic beta is an investment opportunity which has a low beta and yet a higher return than what a model like the CAPM would suggest. Right? So even though you should be able to diversify the risk away, it's still giving you what is an additional return premium despite not having that non-diversifiable risk. So here is a bunch of examples. Let's take catastrophe bonds. Now, everyone knows what happens with a normal bond. You invest in the bond, so you lend. Then you get repaid coupons and over the life of the bond and the face value at the end. With a cat bond, you buy the bond, so you're investing, you're lending. Then you're getting the coupon payments over the life of the bond, and they're quite high coupon payments. But if a catastrophe occurs, like a hurricane or an earthquake or whatever is linked to the bond, all remaining payments are forfeited. Right? So you're only getting payments unless a catastrophe occurs, then they stop. And they were created as a way for insurers to essentially on-sell the risks to get it off their books. It is a form of insurance. Now, the risk of catastrophe might be high. You might be in a hurricane-prone area. But it's pretty unlikely that a hurricane is going to cause global equity markets to decline. Not impossible, but unlikely. I'm going to say it is impossible for a drop in the world equity markets to cause a hurricane, right? So this is something that you should be able to diversify away, providing you hold a well-diversified portfolio. Yet cat bonds are offering a persistently higher return than what the CAPM will suggest. Now, exotic beta opportunities, they don't last forever. At some point, people cotton on, demand goes up, future returns go down, and the opportunity disappears. But for a while, at least, in the medium term, they're giving you an additional return despite being able to get rid of the risk yourself. So if you can find an exotic beta strategy, it can be quite useful. Commodities has been seen as exotic beta for quite a while, but we're going to talk in the Commodities Week about the fact that the return available to commodities is starting to go down. Any questions on any of that? All right, so a couple of things with the exam. The first is that I've put up an exam guidance note for you guys, and I put up one past mid-semester exam. Now, the past mid-semester exams are not a lot of value in this course. They're useful to see the type of question that can be asked, but remember, first of all, the past exam, I wasn't the lecturer. Anything conceptual that's been asked cannot be asked again because you already know exactly what it is, right? It's not like Foundations of Finance where I can just keep changing the numbers, changing the time period, changing the setup. So the reason that we only give you one exam in this course is if we gave you more, that's more questions we can't ask you, which means we need to make the questions harder and more left field to find something new for you guys. So we only give you one to actually make it a lot easier, because just because you can answer a past exam question doesn't mean you'll answer the actual exam, because the question will have to differ, right? So I promise you, I know that a lot of courses, I mean, when I teach something like Foundations, I'll give 5 past exams. I give you one because it benefits you, because I don't want to have to start finding really random parts that we don't cover in a lot of depth, just because all of the other questions have been asked. So I'll go through a couple of things on the past exam in a moment, but if I just talk about a couple of things of the guidance note, this is on Waddle for you guys to read yourself, but a couple of things to draw attention to. I do suggest a 2B pencil because it is easier to erase in the multiple choice section. If you change your answer, please be careful to erase it properly. And it sounds really obvious, but please be careful to fill in the option carefully, because sometimes people get a little bit messy and wild and the machine actually won't pick it up. So be careful when you do fill in the multiple choice section. You're going to have 16 multiple choice questions worth half a mark each, 4 written answer questions, each worth 3 marks, and some of them are multiple part. You can have a dictionary, but please have no markings in it. We will be going around checking. You can have a non-programmable calculator, and you can have a one-sided page of notes. Please leave the other side completely blank. If it's not blank, the invigilators have to take it from you. And it can only be 1 page. I've seen this a lot. Don't have little bits sitting there stuck onto the page that lift up like a door so you can see something underneath. 1 page only, has to be flat, nothing stuck on top of it. You'd be surprised how often I see it. And props for ingenuity, but it's not allowed. Okay, so only one-sided, and it can be handwritten or typed. But if I can give you some advice, if you're anything like me, the act of creating that one-sided page of notes is revision in itself, because you're going through deciding what do I put on, writing it. Often to learn, you should use as many of your senses as you can. So read it, write it, say it as you're writing to take advantage of it. And as you put it together, you're going to become really acquainted with where everything is, because you're creating it by hand. It takes longer, but you learn it better, you understand it better, and you can find it easier. If you just take the lecture notes, scrunch them into tiny bits and just stick them all over it, you're not learning as effectively because you haven't processed the information as you've gone along. Another thing, I often recommend doing it in landscape rather than portrait, and create little boxes that you fill progressively, put it in topics, and then use different colours and use highlighters. So when I used to do it, for example, information was in blue, formulas was in black, notes to remember or examples were in green, and the headings were in red, right? I had those 4 colour clicky pens. And then around the sections where they were like big divisions in areas, so for example, modern portfolio theory, around that I would put a yellow highlighter so that I can easily see all of this area is covered in this part of the page. You can fit a huge amount on if you do it like that, and it's easy to find as well. Okay, so most of this is self-explanatory. You can see only 12.5% is calculation-based. So for a finance course, light on calculation, heavy on concepts. Calculations could be any calculation work in lectures, workshops, Excel, or choose, given that you only have a calculator and a pen. So obviously we're not going to ask you to do a bootstrap. You can't do that use it by hand. If I do ask you to calculate something using returns, I'll only give you 5 or 6, right? I'm not going to give you a series of 20 different time periods. But it will be simple. It might be a simple version of something you've done in Excel, providing you can calculate it by hand using a calculator. It's everything up to and including week 5. That ends on Friday. Okay, so it includes tutorials. So it includes the tutes in week 2 and 3 and in week 4 and 5, but it doesn't include the tutes where you discuss concepts related to what we're doing now if the tutes don't occur in this week. It does include the Excel video for today, but not the interpretation from the tutorial. Does that make sense? So just ask yourself, is the information covered this week or before this week? And if the answer is yes, it's included, but nothing that you're going to cover in the future. Now, we're going to go through a couple of things about the practice exam now. I'm not going to give model answers to the past exam questions because, 1, they're not relevant. 2, people worry, oh my God, but I might have said something slightly different. That's fine, right? It's only model solutions if your answer is valid. If it's an example that isn't included on the solutions but is a legitimate example, you'll still get the marks. But I will give an example of I'll show you a written answer solution so you can see the type of thing to look at. Now, I've given you a list of topics that you might want to structure your one-sided page of notes around. I've made a couple of notes about what's examinable in terms of Excel works and tutes and readings, and I've given you some advice as well. Now, it looks like week 8 and week 9 is when we're going to actually give you the exams back to have a look at. I'm not going to post the solutions online, so it's really important that you do go to your tutes if you want to have a look at your exam script. So, any questions on any of that? Let me talk quickly about a couple of multiple choice in a moment, but first, one of the written answer solutions. Eventually, here we are. And that's question 18. I've chosen question 18 because things have changed in question 17 so that the answers to question 17 wouldn't apply today in some cases. And the weeks have changed. For question 19, you haven't done hedge funds yet, so that question wouldn't be asked. Question 18 won't be asked because it's here, but could have been. So I thought that would be a good example to show you what the solutions look like. Now again, if you would have given a different example, as long as that example is valid, it's okay. That's why I really worry about giving the example solutions in this course, but I wanted you to see the way that the solutions will be set up. So the question says, what are 4 problems with using modern portfolio theory to form portfolios? It used to be covered in Tute 3. That's changed now, obviously. It's covered in your tutes, you know that, but it's not called Tutorial 3. The concepts are covered broadly in weeks 3 to 5. Now, you can see this is what I want you to have a look at. The answers to the written answer don't just regurgitate the points that you see. In this case, that would have only given you half of the marks. Sometimes it might give you 2/3 or 3/4 of the mark. But typically, you need to show examples and in-depth explanations. Now, in my exams, when I write them, if I want you to provide an example, I will say, explain with an example, right? But as a general point, assume that you will usually be asked to provide an example or illustrate it in context, because that's what this course is about. So don't just regurgitate the dot points. You'll pass usually if you regurgitate the right points, but it's not going to give you 100%. Explain it. And everyone's explanations will slightly differ. So you might have answered these major points. In my exam, I would have said, please provide an example for each. So, for example, objectives are usually broader than just optimizing the trade-off between mean and variance. As an example, some investors will also care about illiquidity risk. Some investors will care not just about mean and variance, but skewness and kurtosis, and you'll give some reason why. So if you are an investor in a hedge fund, we haven't done this yet, but if you're an investor in a hedge fund, fees are nonlinear, so your returns are nonlinear. It might be that you're an investor that has a huge exposure to a particular asset through their jobs, like property. So you care not just about the mean and variance trade-off of direct property, but the fact that you want to take on a diversifying exposure in your portfolio to diversify your job market risk. It doesn't matter as long as your example is reasonable. Does that make sense? So you provide the point, then you provide an elaboration. And you do that for whichever points you look for. These were the major points to look for. There were some minor things that don't make optimization pointless, but it does make it difficult, so you could have explained those as well. And remember, you're only describing the 4 major ones, so ideally you'd provide that. But if you'd done this well, minor items are worth marks, not full marks, but you wouldn't have got 0 just because it wasn't a major point. Part B outlined 2 alternative approaches. It could be a lot of different approaches. But notice you've got to identify which problems with mean variance, the problems with mean variance analysis that the approach will help to mitigate. And you can see you could choose the workhorse, liability-driven investing, benchmark relative, fundamental risk. We did these 3 this week, right? And in each case, you're providing an analysis of the problems mitigated. So here you haven't been asked to provide examples, but you notice you are actually not just regurgitating a lecture slide. We've learnt everything that you see here, but you're explaining it rather than just saying, one is liability-driven investing, it is for liability-driven investors, right? It's more in-depth than that, but dot points are absolutely fine. You don't need to write intros or conclusions or paragraph form. Any questions on the way that the written solutions are set up? So let me show you a couple of things about the multiple choice. The first is that there are 2 questions where at least part of those questions are based on supplementary material now, so you wouldn't be asked it. That is question 6 and question 9. Question 6 and 9 you wouldn't be asked because some of the responses, some of the options are based on supplementary material. Now there are a couple of questions where multiple choice is a bit of an art, so I wanted to point out some tricks to the solutions. The first one is question 2. I actually told you about this in week 1 or 2. Which of the following is less likely to be part of the wholesale industry? The answer is retail super funds. The answer is self-managed super funds. It's not retail super funds. Because remember, retail super funds, even though the retail is in the name, they are aggregators. They are part of the wholesale industry. Yes. Oh, crap. Thank you. Thanks for that. Question 2. There we go. The answer is self-managed super funds because they are individual investors. Even though retail super funds have retail in the name, they are aggregators of money from retail investors. The next one that's a little bit tricky is question 5. Question 5 says, which of the following statements about illiquidity is more correct? In other words, you are trying, it's not a definition, it's a statement about illiquidity, and you want to find one that is correct all of the time, essentially. Because both A and C are true, but not all the time, right? Illiquidity could be the additional cost of trading illiquid securities, or it could be that the investor may not be able to sell. It's one or the other, so each one doesn't hold in every scenario, because if you're stuck with a perm, you can't take a haircut because you can't even trade the asset. Does that make sense? So they're both valid, but they're not complete. What is a statement that is always true is that illiquidity can have a significantly different impact across investors. So that's why the answer is B. Right, so you've got to be really careful. It's not asking for a definition, that question. It's asking for a statement. And the other one that I wanted to show you is question 10. Question 10, the answer is B, because it's saying what is the most likely source of why optimization is going to overweight international fixed income. It could be that A is true, it could be that C is true, it could maybe be that D or E are true as well. But the fact is, B we know happens. That is the big problem with optimisation, and that's why B is the correct answer. Right? You've got no real information to suggest that A, C, D or E is right, but you know that B is the big problem with optimisation. So it's not always as simple as one is right and the rest are fully wrong. It's sometimes which is the best of the options available. Now, are there any, and actually pause for one tick, let me just, in case there are,